guys.
Hey, Tanya, how are you?
Good. So let me do that share host stuff, make co-host.
Awesome.
Yes. Make co-host, make co-host. Yes. Okay. Okay, so you guys are good with controlling the screens and everything?
Let's see.
Matt,
Okay.
Yes.
did you get
Awesome.
what I sent you?
That answer your question?
Yep.
Yeah.
Great, thanks.
Cool. Yeah, Manolo edited it. Perfect. We got this edited.
Oh, nice, nice, nice. She looks like me.
You're better looking.
Thank
Hey, Tanya.
Someone asked me for a picture the other day, and I'm like, the last picture I have is like from 6 years ago. I have no beard. I'm like, I look way too young.
Listen, the same with me. I've been using the same picture that when I was 24 or something. I definitely need new pics.
Hey, that's what I look like before shelter in place.
Oh, wow. I love it. It's really nice. Someone just joined us. Hi, Jean. Okay, yes, he'll be muted on entry.
Hello.
Hi, good morning.
Good morning.
Welcome, welcome. We're just waiting for 10 o'clock to get rolling. So we have about 3 more minutes.
I'll give them maybe 2 minutes for like stragglers. 2 after 10.
Yeah, that's why we're gonna do the icebreaker for the stragglers to not stragglers, but our people who might have technical difficulties. Okay. All right. Jean Bernard, if you have any questions, that you just have to the top of your mind, feel free to type it in the chat, and we would make sure that our team is able to address your questions. You see the chat room? You can send your question either publicly or privately.
Okay, I'll put everything in chat, or am I free to speak as well?
Yeah, you're free to speak as well. Of course, yes. At designated times, when our speaker Matthew would be presenting, when he presents and he lets us know when to speak, that's when we'll have an opportunity to ask verbal questions. But if things pop in your mind and you don't want to forget, you could feel free to put it in the chat. Hi Avril, hi Althea, hi Kadeen. Okay, so we're just with 9:58. Oh yes. Okay, that's our 10 o'clock start. We are going to begin now to respect those of you who joined us early. And we're going to start with just an introduction from myself as well as Sean. Hi, I'm Tanya.
I'm Sean. Yeah.
Okay, and at Robinson Lloyd Resiliency Group, done business as Lloyd and Lloyd, our evidence-based life skills enrichment and enrichment programs will be known globally for increasing resilience and academic performance one school district at a time. Okay, and that's just as we are pleased to host Matthew DelPriore and Manolo Teijelo this morning. Sean is we're going to start off with an icebreaker. And the question, so for the icebreaker, you guys could type in the chat room. We want to know what you would do if you had all the money in the world. All the money in the world, what will you do? What will you do? All right, so those answers should be coming in fast and furious. What would you do if you had all the money in the world? I'm gonna start it off. What would I do? What would I do? All the money in the world. Okay, I'm gonna save half. I'm gonna save half and invest.
Buy land.
Buy land, yes. Buy land. I love it. Travel, buy land, save and invest. What are some of the things you guys really want to do? Don't be shy now.
Pay for different classes.
Pay for different classes. Yes.
Go to
Pay
chef
for
school.
classes. Go to chef school. I like that one, Sean. Go to chef school. On an island. Yes.
That too.
Totally. Okay, I love it. On an island. I love it. What would you do if you had all the money in the world? My mom just popped in, Kathleen. Hi, Kathleen. All right.
Help family.
Oh, yes, buy property, help family. Yes, Raymond, invest some, enable younger family members to complete school. Yes, yes. Travel, invest property. Yes. And guys, you did it. We are out of our time for our icebreaker, but that was fun. And we could do this. We're going to get to these goals thanks to Matthew's help and Manolo's help. So Sean will be introducing Matthew.
Good morning. I'm going to read an intro for Matthew. Matthew began his career in 2005 after graduating from Baruch College. He has built his practice with the notion that he is there to help clients create a financial game plan for the road ahead, helping people make smart decisions about their money based on what is most important to them. He currently manages $250 million in assets, a team of 7 advisors, and surrounds himself with other allied professionals to ensure his clients get the best advice and service. Matthew lives in Middletown, New Jersey with his wife, Nicole, and daughter, Sienna.
Welcome, Matthew. Thank you. Yes.
Thank you. Thank you. Should we kick it off?
Yes, sir.
Okay, perfect. And I'm also joined by our partner, Manolo. And
Sorry. Thank you, Matthew, for that cue. Yes, Manolo, forgive me. Okay. Okay, and we're also joined by Manolo Teijelo. Manolo holds a Bachelor of Arts degree from Purdue University, MBA with a concentration in finance from the Kelley School of Business at Indiana University, 33 years on Wall Street in institutional equities at Morgan Stanley, Lehman Brothers, JP Morgan, FTN Equity Capital Markets, and Think Equity. 5 years at AXA Advisors, 2.5 years at Fortis, Sean, help me. Fortis Lux Financial. Thank you. Fortis Lux Financial.
Excellent.
Excellent. Now, we are so honored to have you just be on the platform with us. We appreciate you guys so much. And we also had Salim Omar, CPA, MBA. Salim had an appointment conflict, but he's letting us know that he would like to do a presentation on starting your small business. So if any of you are entrepreneurs, please say something in the chat room so that we can let Salim know you're interested for the next workshop. All right, and now we could have Matthew take it away.
Great.
Thank
Thank you so much, Tanya. Thank you so much, Sean. Thank you, Manolo, for getting this together. And thank you all for joining us today on a Saturday morning to learn about, financial planning. First and foremost, from everyone here, we hope that everyone is safe, healthy. And for those of you who are essential workers and helping out or have loved ones, we sincerely appreciate them. My wife, being a nurse, always had a respect for what she did, but now even more so. Today's presentation is titled A Top 10 Guide to Reshaping Your Finances During a Turbulent Times. And the reality is, this presentation, we hope that you'll take away things that even during normal times will help you from a financial planning perspective. As Tanya and Sean mentioned, we want to make this interactive. So we're going to continue to pause and make sure that you're getting what you want out of this presentation. So we really encourage questions. There's no such thing as a silly question because chances are someone else has that question. So this is something I've done. This is probably 6 times so far in the past few weeks, and the best thing we can get out of this are questions and making sure there's engagement. So we're going to pause. You can put you can put questions in the chat box. You can raise your hand. You can unmute. This is our email address. So certainly reach out to us with questions if you feel it's more of a private matter. So I think everyone knows who we are. So thanks for the introductions. So first we want to start with the importance of not panicking. I am by no means a psychologist, but I spent a lot of time really understanding behavioral psychology and behavioral finance. And there was a book written by the gentleman, Dan Kahneman. He talks about a book called Thinking Fast and Slow. So first off, it's easy for us for fear to creep in, right? We listen to the media, we have our televisions on, we have the radio on, we're reading newspapers, and fear is easily set in. And the problem with fear setting in is it stimulates the part of our brain that stimulates fight versus flight and causes us to make decisions in an irrational manner. So it's really important that as an individual, we take a very calm approach to your financial planning and not think in System 1 mindset. System 1 is thinking that is very instinctual, it's very emotional, it happens quickly. System 1 thinking it happens throughout our day without even us knowing it. We wake up in the morning, we brush our teeth, comb our hair, whatever it is. It doesn't really take much brain power. In fact, if you want to try this with your spouse later or a significant other or a friend, ask them to spell the word SPOT, S-P-O-T. Quickly ask them, what do you do with a green light? And 9 out of 10 people will say stop, right? That's an example of System 1 thinking, right? It happens at parties all the time. We really need to encourage our clients and the folks we work with to think in the System 2 mindset. And System 2 mindset is really deliberate. It's logical. It allows us to take a step back, really soak in the information and make decisions in a calm state. And there are all these heuristics out there, right? We call them biases, like confirmation bias. The information you're looking for and seeking, you will find. Recency bias, right? Things that have happened more recently, you tend to put more weight on that information. So we need to be mindful of this, especially when it comes to planning from a financial planning perspective. So we're going to get into, when you go on a road trip, and unfortunately many of us have not gone on many trips lately, but when we did, right, when we go on a trip, we take an inventory of what we need to pack our bags and what we're going to take with us. Well, the same holds true with our own personal financial planning. We need to first take inventory before we start going somewhere. So the first thing we encourage our clients to think about is, what are your goals, right? What are your personal goals? What are your financial goals? Because that's really what we're going to help you achieve. And when we help you think about your goals, we help you think of them in a SMART way. And the acronym SMART stands for specific, measurable, achievable, realistic, and time-bound, right? So there's a difference between buying a home, I want to buy a home, versus I want to buy a $500,000 home in 5 years with a 20% down payment, right? It's specific, it's time-bound, it's something we can work backwards towards. So again, use that SMART acronym towards anything, whether it's personal development, family development, any goal that you have, think of it in that way. Then we need to think about the cash reserves on hand. Before we start investing in cash is so important. Cash is king in today's environment because we don't know what may happen from a perspective of our employment, expenses. So make sure that you have cash on hand in a savings account. And so a general rule of thumb, and everyone's situations are different, is if you're a single wage earner, you probably want anywhere from 6 to 12 months of expenses on hand. Because if something happens, you're out of work, maybe your business is not doing as well, we need to make sure there's cash to help pay the bills. If you're lucky to have a spouse or significant other who earns an income as well, maybe we can get by on maybe 3 months of cash reserves because we know that we can depend on another loved one's or your partner's income. So again, especially if you're a business owner, we probably want to even have more expenses on hand because you're not getting a paycheck per se from someone who's paying you from an employer perspective. So even though it may take a year to build up your cash reserve, right? $100 a month, $50 a month. Maybe you get your tax return come April. It may take time, but make sure that's a goal of yours because things do happen and we're seeing that today. And for those of you who may have extra cash laying around, check out some of the online bank accounts. If you go to a website called bankrate.com, you can actually research banks that will pay more than competitive rates than your traditional brick and mortar banks like Chase or HSBC or Citi, right? So bankrate.com, you can actually research places to save in a very liquid FDIC insured manner and have complete access to. Okay. And then take a look at the other assets you have, after tax dollars or retirement assets, right? Retirement assets may have certain restrictions or penalties. So understand what you have and how it's invested, and we're going to get more into that. And then we're going to get into expenses, but before we do, any questions so far about our behavioral psychology or even about the inventory we need to take? Any questions so far? So we're going to get back into the presentation. And the next part is understanding your expenses. As fun as this sounds, and just joking around, right? It's not fun to really put a budget worksheet together, but it's important, right? And so we need to understand what our true needs are versus our wants. And in today's subscription economy, I'm guilty of it as well, right? We subscribe to things that maybe we're not using anymore. Netflix, Hulu, Disney, you name it, right? Are we using all of the minutes on our phone? Are we using all of the channels on our television cable, right? So what are the things that we're using and where can we cut back in? And I always use the simple analogy, if you were to go from whole milk to skim, you're not going to do that overnight. You're going to go from whole milk to 2% down to 1%. The same holds true with our own expense cutting, right? You're not going to go from, dining out 5 days a week down to none, right? So start to cut back gradually, right? Small changes over time lead to a big impact. So understand what your needs are. And what about your expense items, right? Major expense items. Do we need to redo the kitchen? Do we need to purchase, big ticket items, or can we put that on sort of the back burner? And we encourage people to think that way because look, again, we still don't know what's moving forward. I'm an optimist and I feel that, without a doubt, we're going to get past this. We don't know if there's a second wave or other things that are going to impact our lives. We can't count on certain things. So, maybe we should be a little bit more wise in those major expense items. If you're an entrepreneur, maybe you need help, finding money, PPP loans, EIDL loans, you name it. We're here to help with that, right? This is a task. Maybe and your employer, right, you're withholding too much from your paycheck. For example, maybe you have zero allowances, which means you'll get a bigger tax refund at the end of next year, but you're pretty much giving the government more dollars for them to use. Why not use that money yourself? So if you can increase your withholdings or your allowances, that allows for more cash flow coming in the door. Or maybe your deductibles are too low. Hey, I have enough cash on hand, so maybe I don't need such a large deductible on my auto policy or my homeowner's policy. If I can increase my deductibles because I have enough cash on hand, then I can reduce my expense in that insurance. And there's other ways we can look to cut expenses, and those are just some items there. Any questions so far about expenses and anything else?
What is an example of a deductible?
Sure. So here's an example of the deductible. I have my car insurance policy, and the glass coverage is 0, meaning if my glass breaks, I'm not paying anything out of pocket. If I raise that deductible to $500, right, then if the glass breaks, well, I'm on the hook for the first $500, right? Or if I raise my health insurance deductible from, I'm on the hook for the first 500 to maybe the first 1,000, well, that means since I'm taking on more risk, I'm going to pay less in premium. I don't recommend that unless you have enough cash on hand, right, to cover those things can never happen.
Okay. Thank you so much, Matthew.
Absolutely. Okay. So we're going to get back into it. I'm going to go into insurance, right? And I'm a big advocate for insurance, all types of insurance. Our biggest asset, or our most important asset, is not our homes. It's not our 401ks. Our most important asset is our ability to wake up in the morning and earn an income. So we need to make sure that's protected. So let's figure out, your health insurance, right? What do you have at your employer? And if you don't have anything at your employer, or if you're self-employed, what are your options? Does your spouse or significant other have health insurance? Some companies and organizations even allow for domestic partners to go on their spousal plans. So take a look and see if that's allowed, right? Maybe you can go on to the exchange, right? The healthcare exchange, albeit the coverage may not be as comprehensive as your employer, may offer more affordable ways to get coverage. And depending on your income, there may be certain subsidies to apply towards that, right? Maybe you have certain, New York Health, New Jersey Health has, certain programs that maybe allow for free coverage depending on your income. Maybe you have to jump on COBRA, which is coverage that is from your former employer that you're able to take advantage of for about 18 months. What about your life insurance, right? If you have a loved one who depends on your income, what if you're not here anymore? And sad to say, I'm dealing with 2 COVID death claims, right? An individual who was a veterinarian in Harlem, and I have an individual who owned a bakery in Bed-Stuy. And one person didn't have health insurance. And with an 11-year-old, that's going to be that much more difficult on that individual's life. So make sure your family's protected. And it may not be a child who depends on your income. Maybe it's a parent. Maybe it's a loved one or a sibling or someone who has special needs. So make sure your family's protected, and there's very easy ways to get insurance at a low cost. Same holds true with disability insurance. The average 25-year-old today has a 1 in 6 chance of not being able to work due to long-term disability or illness or sickness. So if I was saying to you had a money machine in your basement cranking out $100 bills, you would probably insure that money machine. Well, guess what? You're that money machine, right? So let's make sure you're protected. For those of you who might be closer to retirement and you've done a great job saving, what if you need to go into a facility or have someone come help you? Long-term care is not something covered by your traditional health insurance. So make sure that this is something that may need to be in place. And always double check your property and casualty insurance, right? Homeowners, renters, right? Even if you're renting, check about renter's insurance. What if there's, a leak in your home, or you have all these valuable goods that, something happens. I had a friend who someone stole her bike, but because she had renter's insurance, her bike was covered. We always anticipate, right? A good defense is your best offense. Make sure you're protected because everything else can fall apart. So I want to pause there a little bit and get some feedback on insurance of any kind.
Avril has a question. Siobhan does as well. Matthew, can you explain to the group what is an allowance?
Sure. Great question, Siobhan. So an allowance is on your paycheck, you fill out a W-4 form when you start your job, and you can even amend it during while you're working. If you put the number 0, that means your employer is going to hold the most amount of taxes that they're able to, which in turn, you know, come April, you might get a bigger tax refund, but that was all your money. They're withholding that from your paycheck. I have other folks, my cousin, he works for the MTA. He's like, I put it at a 9. Well, that means they're withholding the least amount of taxes, but you may owe now money next year when it comes to file your taxes. So try to stick around 1 or 2. If you have a family of, you know, 2 or 3, maybe an allowance of 2 would be appropriate, so that this way they're withholding the right amount. Maybe you'll break even. You may not get a tax refund or owe, but throughout the year you have more cash flow coming in. So I had a lady I'm working with down in DC, and she was withholding 4, and she's like, every year I have to pay my taxes. Well, now if she brings it down to 2, she might be more at a break even from a tax perspective.
Oh. Avril wants to know, which life insurance do you recommend, whole or term life?
Great question, Avril. Thank you. And that's, you know, that's the age-old question. So I'll just say what I do for myself. I have a little bit of both. Term insurance is like renting. It's inexpensive. You have it for a period of time, and at some point it goes away. Whereas whole life is like owning. It's more expensive, but it builds equity. There's cash you can use. The reason why people buy life insurance, the number one reason, is to replace an income. If I'm not here anymore, my wife and daughter depend on my income. So it may seem like a lot, but I have like $2 million of life insurance term. It's very inexpensive, but if I pass away, my wife would be able to take that $2 million and invest it and generate about 80 grand a year in income, so that they can pay the mortgage, pay the bills. And then I do have some whole life insurance because it does have some very unique investment components that I can use towards college education or retirement. But for me to get $2 million of permanent life insurance would just break the bank. So I'm a big advocate of getting both, if appropriate.
Okay.
Great question.
Thank you so much, Matthew. Manolo, you wanted to add anything?
No, I think that's very good. And the key is each individual is different. So what's right for you may not be right for me. So, you know, it's not that term is better than whole life, or whole life is better than term. It depends what stage of your life you're in, how many dependents you have, how much debt you have, and so on.
Thank you, Manolo.
Absolutely. Great. We love the questions. Keep them coming. All right, we're going to jump into it. Kathleen, do you have a question?
She raised her hand.
Oh, she's still muted here.
Yes.
We can hear you, Kathleen.
Can you hear me now?
Yes.
Mm-hmm.
Yes, I had term policies to as a lien against my mortgage and so on. And then it came to an abrupt end. What I felt personally, still feel, is that if I had saved that money instead of having it on a term policy, I would be in a better position. And I feel the same way about life policies, whereas life policies is really for your, you know, as part of your children's inheritance or whoever you want to leave it for. But the value of the money, for example, I have term policy for life policies for 200,000, etc. At that time when I took it out, 200,000 was like beyond my reach. But during my last part of working, 200,000 is almost nothing to save from my country.
Yeah, no, I understand where you're coming from. It's like, hey, I could have done better, but you know, if your family depended on your income, and God forbid something would have happened earlier, that would have served a good purpose to have. And I get it. You know, it's kind of like rent. It's a kind of like you know, insurance. You know, if you don't use it, you lose it.
Yeah.
We're still advocates for it, especially for young families.
Yeah,
But you mature eventually.
Yeah, eventually. So that's why it's good. I like that blend, right? You have something for the whole.
Yeah.
Ron had a good question down there too. How much property insurance is appropriate? So thank you for your question, Kathleen, and comment. So your property insurance, try to, you know, make sure that at least the dwelling, right? If your property is worth $500,000, make sure that the property dwelling is $500,000. And then on the liability portion, make sure you're covering your net worth. Meaning, if you have, you know, 500,000 of savings, let's say someone slips in your home, they're doing work. So I had this unfortunate thing happen. My client Norma, may she rest in peace, a UPS driver slipped on our doorstep in Brooklyn when it was snowing. He sued her, and because she didn't have enough of her property limits, she had to come out of pocket to pay the claim. So make sure that your net worth, whatever you're worth, whatever they can sue you for, your liability is up to that amount.
Okay. Avril had a question as well.
Hi, guys. One of the things I found, and I understand what Kathleen was saying, but one of the things I found, because I've had whole life and discontinued it and got term life, but I do agree that you have to invest the rest. You have to keep the investment. The life insurance is very important, I found, but you also have to invest the rest. You can't just do one.
Yeah, absolutely. Yeah. Thank you, Avril. And
Thank you, Avril.
we're going to get into investments, but you're right. A lot of this is also discipline, right? Making sure that you're, there's a plan and you're, investing as well. So good. I love the engagement so far. So we're gonna continue the presentation. Just looking down at the clock, we still have a lot of time, and I'm happy to go over. So review your other benefits. Don't take these benefits for granted, especially if you're at an employer that has them. And if you're not an employer that has them, maybe your spouse is, or maybe you belong to an organization that has these benefits. So personally, I belong to the Financial Planning Association of New York. They have certain discounts that I can take advantage of as it relates to shipping supplies and travel and things of that nature. So I love this here, flex spending accounts or health savings accounts. Money goes in pre-tax, money comes out tax-free, as long as it's used towards health-related costs. And sometimes the difference between FSAs and HSAs are FSAs have to be used by the end of the year. Technically have until March 15th of the following year to use it. If you don't use the money in that pool, it's gone. Whereas HSAs are with you forever. And so even if you have leftover money, so last year I had leftover money in my FSA plan, there's a website called fsastore.com. And at fsastore.com, you can actually purchase things with your FSA dollars, your flex spending account dollars, which is tax-free. Right, so I bought diapers, I bought sunscreen for my baby, all these things that I would have needed to buy anyway. Well, at least I'm using my tax-free dollars to do it.
Nice.
And with the CARES Act is something that's new due to COVID. You can go on the same website and buy Tylenol, Motrin, and other things, but beforehand it needed a prescription from a doctor to use it on the website. Now we can buy those things on the website without any prescription from a doctor. So check out FSA Store, especially these are things you're buying, right? Maybe you have legal plans, right? And I'm going to talk about wills and stuff a little bit later, but these are plans that you can take advantage of for 12, 15 bucks a month and get your will done, right? Or someone help with your closing, right? Because, legal plans can be expensive, but here you have these prepaid legal plans. Okay. Maybe there are other health discounts or welfare discounts. I said before, my wife's a nurse. She's getting discounts between 20 to 40% for major retailers, right? So do your homework, right? Don't take these things for granted. Make sure you're doing your homework. Okay. Next, we're going to get into investments.
Some feedback.
If someone could just mute their line. So we're going to get into investments because a lot of people have questions about investments. So the first thing is we take a goals-based approach to your investing. So buying a house in 2 to 3 years versus retiring in 20, different set of money, different set of circumstances. We're going to invest that differently, right? Because if you're going to buy a home the next 2 to 3 years, that bucket of money is going to be very, very secure. I'm a big believer in being invested in the market, but for the long term, right? Is today the best time to invest? Well, arguably speaking, maybe last month was, but still long term for investing, it's a great time to get in. But if you're buying something in the next couple of years, you need to be more secure. So take a goals-based approach to your investing. Take a look under the hood about how you're invested. So if you have a 401k at work, an IRA, a 403b, right? If you're in the market, make sure you're rebalancing your portfolio. So what is rebalancing? I have a portfolio that's 50% stocks, 50% bonds. Well, now since the stock market hasn't done well, I might be closer to 60% bonds and 40% stocks. So I'm underweight. Well, what you will do by rebalancing is sell off the 10%, sell high, and buy in low. Exactly what we want to be doing. Selling high, buying low. So that rebalancing can impact your return by over 1% in a positive return over a 20-year period. So make sure you're rebalancing over time. And this could also be a good time to reallocate or consolidate your retirement plans, because look, maybe you had a former employer and now you're not looking at that investment anymore. And not all investments are created equal. You have to look under the hood to see how you're invested. And while we'll spend some time here, just my own 2 cents, I favor larger companies over smaller companies. I favor US companies right now over international. I favor technology and healthcare over other sectors like retail and, so on and so forth. One thing I want to talk about, and I do see some questions coming into the chat box, is this the time to buy? Well, look, number one, back to the first thing we talked about, let's reassess our liquidity. If we have no emergency fund and I tell you to invest in the market, then you're out of work or something happens and now you need those funds. When the market is down 20%, we've done more harm than good. So we need to make sure before we start investing, we have our short-term goals set, we have our emergency funds, okay? And then I'm gonna talk about dollar cost averaging and then get back into the chat box and answer some questions. So this is a concept over here called dollar cost averaging. Can you guys see this, Tanya?
Yes.
So dollar cost averaging, simply put, is like, when you jump into a pool or you jump into, your shower, you don't just jump in, you test the waters. Well, that's what dollar cost averaging is. So here's an investor, he or she decides, I'm going to put in $12,000 on January 1st. So I purchased 480 shares, right? 12,000 divided by $25 a share. I was able to buy 480 shares. Whereas this investor up here, he or she has decided, well, look, I'm going to put in $1,000 per month, right? Same 12,000, but as the market declines, he or she is acquiring more shares, right? If I have a $15 a share, well, I can buy more shares. So now at the end of the road, I've acquired more shares and my cost per share was lower. So I have an automatic sort of profit there. So some of you are doing this without even knowing it. Putting money into the 401k plans at work or your IRAs. So look, if you're sitting on $5,000 to invest or $10,000, whatever it is, instead of just jumping it into the market, pick a day of the month and systematically get invested over time. Okay. So I'm going to pause there. We have some good questions coming in. So from Siobhan again, thank you. Is it a good time for people to rebalance at this time? Absolutely. I'll take that as the first question. Typically speaking, an optimal time is to rebalance at least once a year. So I typically tell my clients, look, if you're around November and you're doing your benefits at work, this is a good time to check in your 401k or rebalance. Or if things are deviating by about 5% or more. So this is definitely a good time to rebalance and take a second look at where you're at. Maybe I have too much in international or small cap. Maybe I should put more money in dividend paying stocks. And then is it wise to borrow for myself in a 401k versus taking a third loan in light of the volatile stock market? So great question.
That's a good question.
I do talk about that in another slide, but I'll address it now. We are advocates for borrowing from your retirement plan only if it's a last resort, right? Because we want to make sure that this is money that you're using for retirement. Because when you're borrowing for money out of your 401k, well, then that money is no longer invested, right? So now you're taking money out of the market while it's beaten up and you don't give it a chance to recoup in as much as possible. So remaining invested is so key. I go back to this slide here about remaining invested. This is the first one here. This individual here stayed invested for the last 20 years. Whereas if you miss just 10 days of being invested, right, of some of the best days, your balance is half the amount.
Oh, wow.
That's
So
great.
staying invested is really important. And Dalbar is a study, right? Dalbar is an independent research. You say, look, the S&P 500 over the past 20 years averages 9.5%. Same investor, same 20 years, same time period, same investment, averages 3.5. Why? Because we get in, we get out. We don't know when to, our emotion takes over, right? And so we get out of the market and we don't get back in until we think things are, better. But things are better because the market just jumped up 3,000 points, right? The market at its bottom, the Dow Jones was at 18,200. So if you sold out that at the bottom, maybe you get back in when you feel things are better at 22,000. Well, you just missed a huge run up, right? So staying invested is key as much as it hurts. And that's why we take that goals-based approach, right? If you needed money for a down payment, that money shouldn't have been in the market in the first place. Okay. So good. Any more questions on investments? I want to make sure people are getting some good feedback and questions here. What's the best way, Avril? What's the best way to find a good investment company to purchase a mutual fund? So yeah, I mean, that's a great question, right? There are, 17, 18,000 mutual funds out there. There are a lot of do-it-yourselfers out there. And by all means, if you have the bandwidth, great. Big fan of Vanguard. I use BlackRock, American Funds. There's some really good companies out there. If you want to use Vanguard, very low cost, you can buy like a balanced fund, right? You can buy, I'm a big fan of the Vanguard Wellington Fund. It's a balanced fund, 60% stocks, 40% bonds. There are other companies out there like Betterment, right? That can do it for you, and they do the allocation based on your goals. So, I would stick to things that, names that you've heard of, right? Vanguard's been around forever. BlackRock's the largest money manager out there, Fidelity, right? And try to use target date funds if you want to just kind of set it and forget it. So a target date fund says this: I'm 37, I'm going to be 65 in 2045, right? So I should choose a fund that my retirement date, right, 2045, they're basically going to be, that's going to be more aggressive than a 2020 fund, right? Like someone who's going to retire in 2020 is going to be far more conservative than someone who's going to retire in 2050, right? So they kind of do the allocation for you based on your goals, right? If you have a child going to college, a lot of college funds have these target date funds that get more conservative as you get closer to that goal. And as far as, recommending how much do you start, look, once you have your emergency fund, or look, $50 a month, $25, there's no minimum, just start the habit, right? So I started out, when I first started investing, it was $200 a month. Then I increased it to $250, $300, right? So just whatever you can do, start the good habit today. And again, which banks, banks paying no interest. Again, if you don't have your emergency fund, start the emergency fund first, or maybe start your emergency fund. Look, I have $200 a month. Maybe I'll put in $175 to my emergency fund and $25 more towards my investment, right? So this way you can kind of break it up. And a lot of these online services like Betterment have very low minimums. So good, great questions. Anything else? We're going to keep it open, but any other questions on the investment side? Okay. All right, so we're going to get back into it. Taxes, right? We all love paying taxes. And unfortunately, it's something that we have no choice to do. But I am a big believer in controlling what we can, right? So if we can control how much taxes we're paying, why not do that? So here are some things in today's environment we should be thinking about. Tax loss harvesting. If you have some investments that have losses, you can actually write those losses off up to $3,000 per year for your taxes. Now, we're not big believers in letting the tax tail wag the investment dog. It has to make sense from an investment perspective, right? So if you have a lot of gains because you've done well over the past couple of years, maybe by selling the losers in your portfolio to offset your gains, That's what tax loss harvesting does. It reduces your investment tax bill. How about Roth IRAs, right? So I won't even get into Roth conversions, but I'll just talk about the difference between a traditional IRA and a Roth. Money goes into your 401k or traditional IRA on a pre-tax basis. I earn $50,000. I put away $5,000 to my IRA. So instead of paying taxes on 50, I'm paying taxes on 45. Great, get a little bit of a tax break today. But when I take money out at retirement, every penny I pull out of my retirement plan, my IRAs, my 401ks, fully taxable. So why not look at something different or as an alternative? A Roth IRA, I don't get that tax break up front, but at retirement, all that income is tax-free. And I don't know where tax rates are headed, but this country is $25 trillion in debt. So I can only assume that tax rates are going to have to go up at some point in the future. And historically speaking, we're in a pretty low tax environment. If you look back to the 60s, 70s, 80s, we're in a very low tax environment. So again, let's be smart about how we're investing in the long term and maybe diversify your Roth conversions. Okay, let's talk a little bit about the CARES Act. So the CARES Act has a couple of things that we should be aware of from a tax perspective. Number one, if you're over 72 years old, you have to take money from your IRAs and 401ks. It's called a required minimum distribution. They force you to take money out because they say, look, you've gotten all this time to take, put money in on a pre-tax basis. We want our cut. So the IRS says you have to take money out at 72 years old or older from your retirement plans. If you don't take it out, there's a 50 penalty on what you should have taken. Well, now due to the CARES Act, in 2020, you don't have to take your RMD. And that's good because that's less taxes to pay on money you don't potentially need, okay? Secondly, if you're philanthropically inclined, you tie to your church, you give money to 501c3 organizations or synagogues, whatever it is, you can actually take your RMD and donate it to a charitable cause, and that distribution to that charity doesn't count as taxable income to you. So if you are taking money from your IRA and you're making charitable contributions, take advantage of what's called a QCD, Qualified Charitable Distribution. And for many of us, we're not 72, but maybe your parents are or loved ones. Share this with them because that's a good way to save money on taxes. And then for those of you, I think it was Siobhan asked, or maybe Avril, about 401k distributions, right? So under the CARES Act, so prior to CARES Act, I'll say, if you're 59 and a half or younger, if you take money from your 401k or your IRA, you're going to not only pay taxes, but you're also going to pay a 10% penalty. And there's some exceptions, first-time home purchase and disability, but in more normal circumstances, you take money out of a retirement plan, taxes, and the 10% penalty. Well, now under the CARES Act, two things are happening. Number one, no more 10% penalty, as long as you've taken a distribution for COVID-related issues. And it's pretty wide, right? You could have lost your job, furloughed positions, maybe you're earning less income. And not only are you avoiding a 10% penalty, but if you take money from your 401k or IRA, you still have to pay taxes, but now you can pay those taxes over a 3-year period. So it helps, ease the burden of, hey, I just took 10 grand, I'll have to pay 2 grand in taxes. Well, I can split those taxes up now over 3 years, 2020, 2021, and 2022. Okay, so just be mindful of those items. Again, not a big fan of taking money from an IRA to meet short-term needs, but better to take it than accumulate debt and pay 20%, 30% interest somewhere else. And of course, as it relates to taxes, make sure you're working with a professional, right? Whether it's myself, Celine, your own accountant, make sure that everything's coordinated. So I'm going to go into restructuring debt, but before I do, let's spend some time on taxes. Any questions on taxes or comments? And as you know, taxes are not due until July 15th of this year, so we have a little bit of a break there. No one wants to talk about taxes. I don't blame you. All right, so let's go on. We're going to go on to refinancing debt and talk about student loans and refinancing. So this is actually some of the silver lining that's come from this. This is a great opportunity to look to refinance or handle your debt. So number one, let's start with student loans. If you have a federal student loan, you're automatically on deferment until September 30th of this year with 0% interest. Well, that's great news, right? So that's money you don't have to pay towards your loans. It's 0%, so why pay it down? Let it accrue at 0 and take that extra cash and pay off other debts or build your emergency fund, whatever it may be, okay? If unfortunately you have student loans that are not public, right, that are private, there are a lot of good companies out there that are out there refinancing student loans. Gradfin, Common Bond, SoFi, First Republic, just to name a few. So do your homework, right? There are companies out there that are getting very, very aggressive that they want to refinance your debt. And so if you're paying 8, 9, 10% interest, these companies might be able to refinance it at 4 or 5%, right? So better to, here's a cool rule that I'll let everyone into. Rule of 72. Take an interest rate, divide it into 72, and that's how long it takes your money to double. So if I have a credit card or student loan interest I'm charged 6%, 72 divided by 6 is 12. That means it's going to take 12 years for that balance to double. What if I had a credit card at 10%? Well, 72 divided by 10 is 7.2. It's only going to take 7 years for that balance to double, right? So take advantage of refinancing because money will double quicker at a higher interest rate, all right? And then what about your home? What if you have, if you're over 4.5%, 5% on your mortgage, definitely a good time to potentially look to refinance. Not for everyone, but it may make sense to refinance. Or maybe you have credit cards. I had like 6 clients this year already. I've referred to brokers to do a cash out refinance. Pay off your credit card debt, take money out of your home, right? Because credit cards are getting charged 7, 8, 12, 20, 30%. And use the home 4% to pay off your credit card debt. So maybe it's a home equity line of credit. Maybe we talked about life insurance before. Maybe you have some whole life insurance with cash value. Great place to look to borrow because essentially you're borrowing at no interest, right? So look at refinancing your debt, controlling what you can, right? We can't control the stock market or returns, but we can control how much we pay on our debt to a degree. And then the last is understand your payment options. The answer is always no if you're not going to ask. So ask your landlord, ask your mortgage company, ask the person you lease or buy your car from, can I defer my payments, right? Even if it's buying time, maybe you have to pay them back, but if you're able to buy time, why not, right? So ask because the answer is always no if you don't ask. All right, so looks like we got some questions here. More of a comment, but Shanice, is there anything in particular about taxes or student loans? And I'll kind of tailor it in. Student loans, depending on how much you earn, up to $2,000 of the interest is actually tax deductible. So make sure that if you do have student loans that you're letting your accountant know the interest may be tax deductible. Okay. So yeah, so I've been going back and I can share, and this is the thing, we have our email addresses. I have a lot of resources to share. There's an organization I've partnered up with called Gradfin. They basically go out and shop for you. Hey, based on your situation, this is the best place to refinance your student loans, right? Because, First Republic is probably the best one out there, but they have very strict underwriting. They want you to become a client of theirs. Whereas, Common Bond and SoFi, they're pretty good as well, but, they don't have as more competitive rates. So check those out. All right, any other questions before I move on? Okay. So we're almost towards the end and we're gonna keep more time for Q&A. Reassessing your overall estate plan. Again, Not something that's fun. People don't like to do this stuff, but it's important, right? So first, let's start with how your assets are titled, who you name as a beneficiary, right? Who you name as a beneficiary will supersede your will. So I can name Manolo as, hey, Manolo's going to get everything in my will. But if my wife is named as a beneficiary on a retirement plan or my life insurance, she's getting that, no questions asked. So some assets know where to go when you pass, some don't. So here's a great time, because when you sign up for your employer's plan at work and you get the free life insurance at work, it doesn't come with a beneficiary designation. So double check them. Maybe you've gotten recently married. Maybe you've recently divorced. You know, maybe you've had a passing in the family, or maybe there was an addition to your family. Make sure that during these life changes, you're updating your beneficiaries. The last thing you want is your ex to get your money when you didn't want that to happen. And there's been case law that has happened, and it's unfortunate. All right. So double check your beneficiaries. As far as wills and legal documents, also very important. Because if you don't have a will, the state has one for you. You may not like what that has to say, right? So, you know, I was dealing with a lady yesterday. She has a son. She has a partner. They're not married. And in that circumstance, you know, he would have to go to the courts, get guardianship provision. It'd be a pain in the butt, right? So again, meet with an attorney. Estate planning is not just for the rich. Everyone can use estate planning and wills. And if you don't have a lot or think it's expensive, again, maybe there's a legal plan at work, or check out LegalZoom, right? LegalZoom.com has some great templates that, as long as you file it and with, you know, with the county, those wills are legal. And it's also your living documents, right? What if I become incapacitated and I can't make decisions? Who's going to make them for me? Those are things that we need to have in paper. And even more so in today's environment, there's a new legislation around digital assets, right? Facebook accounts, LinkedIn, usernames and passwords for all the stuff that we have, right? You can now name someone as a fiduciary for your digital assets. So again, times are changing. Let's make sure you get your ducks in a row. All right, I see some questions here. Where's the best place to restructure debt? Credit card debt specifically. So yeah, I mean, you know, you would, again, back to taking an inventory, of what are my balances, what are the respective payments, what are the respective interest rates, right? And then you can start to figure out, well, hey, maybe I should pay off this one first and start to, you know, let the other ones grow, right? Or pay the minimums. Maybe I have a 0% offer. We always get the 0% offers, but just make sure you do the homework, right? If you want to buy some time, maybe you can move a high balance to a 0% offer, but sometimes 3%, you pay a 3% transfer fee, right? So make sure that you do your homework when you start to restructure debt. So start with the highest interest rate first. And starting to think about wills, look, if you have a family, start thinking about a will, okay? Yeah, we have, this account here has an hour long, so we get 7 minutes to go. So I'll very quickly answer this question. A will and estate. A will is just basically directs what you want to see have happen. Everyone has an estate. Estate's just an inventory of your assets and your liabilities, right? So they're going to look at your estate, but the will is more of a direction. It's a written legal document, okay? So I want to go into, just very quickly, I won't get into this. We've talked about this. This is what we do here at Fortis Lux. We take a look at all these different areas, and we help you make decisions based on what's most important to you, your goals and objectives. So we're here to help. And then I'm going to leave with this and then keep it open to some questions. We have to get these things approved, these presentations, and they took out a slide, which I don't know why. But here's the last thing I want to leave with for everyone. The most important thing we have from a financial perspective is our human capital, right? So we are faced with more time than ever. So this is a time to go back and say, you know what, maybe I should take that extra class, sign up for that extra designation. You know, what can we do today to put ourselves in a better position moving forward once this crisis is over, right? Because it's one thing to say, what can I cut in expenses? It's another to say, how can I make more income out of this moving forward? How can I improve my business, improve my skills so that I'm putting myself in a better position to better myself and my family? So work on your human capital, build it into your schedule. And with that, I'll keep it open for some questions.
Just before we go into our questions, I just wanted to take an opportunity really quickly to give a testimony. You know, this event came about because of Manolo and really wanting to educate everyone. Manolo has been working with Sean and myself, and you know, him and Matthew and Salim and their company, their group, really helps us to breathe a sigh of relief and knowing where to head to, the direction that we had to go, increase stability, as well as, you know, introduce us to new concepts. Like we now do 12-month plannings. You know, we've been sticking to budgets and it's been making a huge difference. We have a baby that's 22 months. You know, so just giving us that direction meant so much to us, and we wanted to share with you guys as our friends and our community. So Manolo, huge thanks to you for helping to put this together. And Matthew, your information has been awesome. And I'm gonna let Sean is giving me the sign, wind up, and so that we can get some questions in. But I just had to say thank you guys. Thank you so much.
Our pleasure.
So we have a question from Katie.
I'm based in Trinidad and currently an investment analyst is reason designed to work towards services. Awesome. That's great. That's great, Kadeen.
This has been great. Thank you, Kadeen.
Yeah. So maybe, Kadeen, we can talk offline about how we can partner, because I have a lot of West Indian clients, and especially those that have properties down in the islands and stuff. So let's connect offline, Kadeen. We'd love to chat, learn more.
Yes, also guys, Matthew would be contacting you. We would share your contacts so that he could reach out to you guys and you guys could have a direct link.
Awesome, great. Thank you, Kadeen. Cool.
You have any more questions running? We'd love to talk. Yes, we'd love to talk to Matthew. Okay, so guys, we're gonna definitely do a direct connection. Most local advisors primarily sell insurance, but people need so much more. Thanks very much, everyone. True. Okay, so would you guys like to have this again? Maybe next month. Would you like to have it again? Say yes. You can let us know. We would for sure. Yes. Okay. All right.
Awesome. So maybe what we can do, if the participants want to email Tanya or myself like different topics, we can kind of gear it and maybe just kind of create something that, you know.
That's a good idea.
Yes, that's an awesome idea, Matt. Yep, guys. So what we'll do now, we have a question from Kathleen.
Sorry, I'm unable to get the chat down. I found this quite edifying, and I really hope I could spread the message on my end in Trinidad here, because I took my notes, and I'll be letting at least 2 people I know who could work with this. I have made some of the mistakes, like the financial behavior. When gas went down, I got scared and sold cheap. So, you know, and now I bought and I'm looking at it and I'm staying very far, and this is testimony that I need to do that. And so I'm going to spread this message here. I don't know what it's worth, but to you, you know, in terms of your income, because I know this is not something free, but I hope people will latch on. I think it's great.
Thank you.
Yes.
Thank you very much.
Thank you.
Thank you, Mr. Manolo and DelPriore.
Our pleasure.
Matthew.
So yeah, topic: buying investment property, buying a home. Love it. We'll do that for sure.
Yeah.
Yes.
Yeah, investment property is nice. That's a nice.
Manolo, any words of wisdom? We should have 10 minutes grace.
Yeah, no, I think the only thing that I would add is there's a saying that, you know, you can lose everything you have in life. You can lose your house, your job, your possessions, but the only thing you can't lose is your time. So focus on the day-to-day, focus on your time, the families, members that you have and love, and everything else will come into place. Talk to an advisor, an accountant, somebody who's got expertise, so that you don't worry about that and you do the things that are important to you, spending time with your family.
Thank you, Manolo.
Yes.
Thank you. Well, this has been really, really awesome. Thank you so much, Matthew, Manolo. Thank you guys for being here. We really appreciate you.
Absolutely.
All right. And I'm going to be making sure you get an email straight away. Look for it today. You would have, I'm going to send Matthew the information as well so that you guys could be in direct communication with each other. All right. So if you had any questions, anything came up, you could ask direct questions. I'm going to make sure I do that link. All right, Colleen, Avril, Shanice, Siobhan, Marva, Katie,
Video be available.
the Rogers. Will this video be available for watching over on our own? I'll try. I'm new to this techie. Sean could be able to help me. It is. Yeah, we'll figure it out, guys. We'll figure it out. We'll do our best to get it to you. All right. Bye, guys.
Thank you, Sean and Tonya.
Welcome. Thank you, everyone.
I realized I was just replying back to Siobhan. I didn't send to everyone. All right, I've been typing a whole bunch of stuff in, and I'm totally going to Siobhan. I put a whole bunch of different websites in here for people to look at.
Okay.
Oh, okay.
All right. Well, when I send you the mailing list, you can probably send it as well too.
Okay.
All right, guys. Bye, Mr. and Mrs. Rogers. Bye, everybody.
Bye.
Bye-bye. Thank you. Okay.